Very good morning to one and all. So I'm delighted to meet you in yet another presentation, which is a continuation of what you've done last week. This is part two on impact of COVID-19 in the oil industry. With you is Dr. Nabil Ahmed. I take this opportunity to wish you a very happy Ramadan Mubarak. Stay healthy and stay safe. The legends used in this presentation will be looking at FDI, foreign direct investment, OPEC, Organization of Petroleum Exporting Countries, PSU, the public sector units, and WTI, the West Texas Intermediate Contracts. So schema for today, we are looking at certain introduction. We see from India's point of view the foreign direct investment relating to the petroleum industry and certain factors affecting the oil industry. Today, the industry's outlook and its impact due to the COVID and certain measures taken by OPEC and the government and certain declaration of cooperation between the nations on cutting oil production. So having a look at the industry overview, especially to India, the oil and gas sector is one of the core industries in India as it plays a major role in influencing decision making for all other important sections of the economy. That's primarily because India's economic growth is very closely related to energy demand, and therefore the need for oil and gas is projected to grow more once the COVID season is over, that is post Q2 2020, thereby making the sector quite conducive for investment as we move along. Though it is not so the case as on date because of the issues in the oil prices. In terms of foreign direct investment, the government allows 49% FDI in Indian petroleum sector under the automatic route in petroleum refining by PSUs without disinvestments or dilution of domestic equity in the existing PSUs. Same time, 100% FDI equity inflows in petroleum is allowed in exploration activities of oil and natural gas fields under the automatic route. Other opportunities are 100% FDI is allowed in infrastructure related to marketing of petroleum and petroleum natural gas products under the automatic route. During the period of April 2009 to March 2019, India acquired FDI amounting to close to USD 7 billion into the investments under various petroleum products and activities and industries. That's a huge amount of money as an inflow as foreign currency into the economy. Certain factors affecting the oil industry. From the supplies perspective, we can see that any ample supplies means the barrel price falls down. And when supply is low, the price increase, which is basic demand and supply concept of economics. So supply levels vary depending on current production and the current demand. OPEC accounts for close to 40% of the crude oil production in the world, and close to about 60% of internationally traded petroleum is exported by the OPEC countries. With such a large share of global oil output, OPEC has a strong impact on the supply. The organization can either restrict or increase the supply depending on the global requirements as well as the global pricing changes. Demand completely depends on economic factors, and as on date, when you see China, which is one of the largest importing oil importing countries in the world, had been in lockdown for a few months, the overall requirement for oil itself has really fallen down. So with COVID, can't be certain that the global we can be certain that the global demand has fallen over 30% for the time being due to the shutdowns globally. Future reserves. Many countries hold reserves of crude oil for times when oil prices increase dramatically. The government stockpiles crude oil when the barrel prices are low, and this is typically what the US government had done, where they've increased the reserves by 75 million barrels when the prices actually went to negative. So if the price spikes, the country pulls from the reserves to help minimize the impact on increasing oil prices. From the geopolitical points of view, since supply is determined by big oil producing countries, tension with one of those nations causes major problems. So if you see any issues with Iran or Iraq, automatically you can see that the oil prices are booming up. So if there is war or conflict in any of the oil producing region, crude industries could seem threatened, and that could ultimately affect the oil prices. Looking at Chinese demand between 2012 to 2018, we can see that from close to about 10.2 million barrels per day, it's gone up to 13.5, which is a good 30% increase in 5 years. And China is considered to be the largest importer of oil in the world. China's annual crude oil in 2009 increased to an average of 10.1 billion barrels per day on an average. China remains the world's top crude oil importer, surpassing the US in 2017. And in today's scenario, President of United States of America, Donald Trump, has also said that due to the oversupply, they might even look at not importing from OPEC countries and trying to reuse or get the oil reserves from the local US uh, inland production of WTI. China's new refinery capacity combined with flat domestic oil production were the major factors contributing to the increase in China's crude oil imports in 2019. Looking at the Chinese economy, more than half of China extended a Lunar New Year holiday by at least a week, and then it went on to months due to the effort to blunt the spread of the virus. Nearly all major enterprises had resumed work, with return to work for smaller business has stopped 80%. However, business activities is just getting back to normal, especially in the service industries. And the spread of the virus overseas had led to the drop in demand for Chinese exports. China reported Friday that its first quarter GDP contracted by 6.8% in 2020 from a year ago, as the world's second largest economy took a huge hit from the coronavirus outbreak. And other countries are just short of giving their data for their quarter ended 31st of March very soon. So, where you can see that various countries were badly impacted due to the COVID shutdowns. From an exporter's point of view, if you look at it, Saudi has been the leader in terms of exporter of conventional crude oil, and then followed by Russia, and then followed by UAE and Canada and Iraq. That's followed consistently over the past years between 2013 to 2017. Now, looking at the industry outlook, the global attention is increasingly focused on the need to accelerate clean energy transition in order to mitigate the risk of climate change. With its major emission footprint in the energy sector, including the oil and gas industry, is at the heart of the matter. Demand growth for gasoline and diesel between 2019 and 25 is set to weaken as countries around the world implement policies to improve efficiency and cut carbon dioxide emissions. The rising popularity of electric vehicles among the public worsens the situation for the energy sector to add on. The oil demand growth slows because demand for diesel and gasoline nears a plateau as new efficiency standards are applied to international combustion engine vehicles and electric vehicles hitting the market. So from this we can understand that overall, as we go on, it's more into look into minimizing the emission footprint and making sure that the risk of climate change is adhered to. Hence we can see that alternative sources of energy is being used more than the oil requirement. In the present scenarios of oil futures, US oil prices traded below zero for the first time ever in history, meaning certain producers or traders were especially paying other market participants to take the oil off their hands. The price crash came as the US benchmark oil contract known as a WTI West Texas Intermediate headed towards its expiry date for May delivery, the month when demand hit from lockdowns and travel restriction is expected to peak. Each month, WTI future contracts, which trade on the CME Group's New York Mercantile Exchange, need to be settled with physical delivery of crude oil. And hence, analysts believed a lack of available storage capacity of the WTI contract's delivery point of Cushing, Oklahoma, set off panic among traders holding derivative contracts who found themselves with nowhere to put the oil. Those not intending to take physical delivery had to square off the contract before the expiry date. So speculators who did not want to take delivery in May proceeded to unwind their position, leading to massive fall in prices, leading to close to about minus $38 per barrel, and then it rebounded. Although the May WTI prices went negative, June future prices are hovering at around 20 a barrel, and the following months we'll see in the next slide they are about close to about 25 and 30 a barrel. The reason for it may be due to the speculation that the oil demand may increase or the storage space may be created once the lockdown reopens. So having a snapshot of the future contracts of WTI between May to September, we can see in the third last column or the fourth last column that they're trading somewhere around $28 to $30 between 2020 June to September. Now, just to throw some light on the WTI crude and the Brent crude, Brent oil has traditionally quoted higher than WTI, with the difference being around $6 to $7 a barrel between the two. Brent is a superior grade and it's produced in the North Sea of the British coast, and it's accepted benchmark for this part of the world. The market that it serves is considerably larger than that of the US, and demand is therefore higher. Transporting oil from the US to Asia is not economical, thus limiting the scope for the WTI grade. Refineries in Europe are configured for Brent rather than WTI. Prices of Brent are therefore always higher. And having the production in the sea and having the production on the land makes a big difference. One of the reasons for high price for Brent crude may be due to the oil storage facility. Since Brent crude are produced in the sea, they can utilize the oil tankers for storage. However, WTI crude is produced on land 500 miles away from the sea. This gives an edge to Brent crude in the storage aspects. So, having some insights on the impacts of COVID-19, the pandemic crisis had triggered large erosion of demand globally, resulting in a sharp decline in crude prices. The arrival of the coronavirus is rattling a global oil market that is already facing challenges. And the demand side, the growth in 2019 was significantly weaker than expected, and a new vehicle efficiency measures have started to weigh on transport fuels, again, thanks to the reducing the global carbon footprints. On the supply side, geopolitics remained a wild card. Even before the coronavirus, market had oversupplied, leading OPEC producers to cut output. One of the largest contributors to the global oil demand destruction is the falling airline industry, with the grounding of most international and even domestic flights as on date. The spread of COVID-19 poses a significant threat to the global oil and gas industry. Continued operations will likely become increasingly difficult due to workforce shortages as employees are infected by the coronavirus and the practical difficulties in many cases of social distancing. China's oil demand growth accounted for more than 80% of the global oil demand growth. The shutdown of the Chinese economy in the wake of the virus has triggered a collapse in the global oil demand of close to 1.1 million barrels per day, and that's increased to significantly 2 to 3 million barrels per day, which accounts for more than 30% of the global oil production per day. And hence OPEC is taking some steps in terms of forecasting further pain and weak oil crude, because of which, according to his monthly reports, global oil demand is slated to drop by 6.8 million barrels per day this year. The International Energy Agency has also forecast that oil demand will plummet as the coronavirus pandemic continues. So far, the restrictions imposed to control the virus have led to tumbling fuel consumption amid product inventory builds, severely damaging jet fuel markets and diving gasoline margins into the negative territory. From the growth forecast, it doesn't look very promising. Oil prices continue to fall, charging towards a new 18-year low as gloomy demand outlook persists even after a historic production cut last week by close to about 10% of the oil production. Oil prices have declined 20% even after OPEC agreed to a historic oil production cut. And Moody's Investor Service sharply cut India's growth forecast for calendar 2020 to 2.5% from 5.3%, nearly half. Moody expects real GDP in global economy to contract by 0.5% in 2020, followed by a pickup to 3.2% in 2021. Although governments and regulators globally are taking measures to contain the impact of the economies, which are likely to grow and deepen, the downside risk to growth remains sizable. Fiscal and monetary authorities are stepping up the level of support to their respective economies. Thank you so much for listening to the wonderful presentation, giving credits to Mr. Jugal. Look forward to meeting you in yet another presentation next week. Have a nice day. Stay safe.